In this TaxSlayer training video, we'll discuss Forms 1099-A, the Acquisition or Abandonment of Secured Property, and 1099-C, the Cancellation of Debt. The objectives of this training video are to distinguish between the Forms 1099-A, Abandonment, and 1099-C, Cancellation of Debt. We'll determine if there's taxable income to report. We'll talk about completing the Form 982, Reduction of Tax Attributes due to Discharge of Indebtedness. We'll talk about how to enter a few examples in the TaxSlayer Pro Desktop software. First, some definitions and terms. A foreclosure is when a borrower in default is deprived of his or her interest or rights in a mortgaged or secured property. This is often a lengthy and expensive legal process, and the laws and procedures can vary from state to state. The lender regains possession and control over the secured property, or, again, a repossession. For tax purposes, a foreclosure is treated as a sale of the property, so the borrower will have a realized gain or loss. Abandonment occurs when a borrower voluntarily and permanently gives up possession and use of the property with the intention of ending his or her ownership. There's no direct conveyance to the lender. An abandonment is also considered to be a sale or exchange of property for income tax purposes. An abandonment is most often reported on Form 1099-A. Voluntary conveyance, voluntary surrender of property to a lender in exchange for full or partial discharge of the debt it secures, is considered voluntary conveyance. It's not considered to be an abandonment. It's also considered to be a sale or exchange of property for income tax purposes. And it's an alternative to the foreclosure process. As tax preparers, our main function is to help our clients understand what's going on the tax return. What do the documents mean that they've received in the mail? On the other side of the desk, the client's perspective on foreclosures. We've probably heard phrases like this: the bank just took my house. I don't understand the whole paperwork process. I just don't want to deal with it. They just kicked us out. And again, it's our job as preparers to help the client understand what's going on the tax return and how to report a 1099-A or a 1099-C that the client may have received in the mail. Form 1099-A. Box 1 indicates the date of sale. In other words, the date of the lender's acquisition or the knowledge of abandonment. That's why we have sale in quotations. Box 2 indicates the amount owed or the balance of principal outstanding. Box 4 indicates the fair market value on the date of the quote sale. This is the gross foreclosure bid price. Box 5 indicates if this was a recourse loan. If this box is checked, the borrower was personally liable for repayment of the debt. Box 6 gives a description of the property. Now, we talked about recourse debt on that form just a moment ago. So what's the difference between recourse and non-recourse debt? Well, recourse debt, the borrower is personally liable for repayment of the outstanding debt after the foreclosure sale proceeds have been applied. The lender can pursue a deficiency judgment, and recourse debt cancellation may result in taxable income to the borrower. Non-recourse debt, the borrower has no personal liability after a foreclosure, and no taxable income results from the cancellation of debt. Now, going back to our Form 1099-A, the difference between recourse and non-recourse debt. Recourse debt, box 5, is checked. The sale price indicated on this form is the lesser of box 2 or box 4. Again, this is if the recourse debt box is checked. The sale price is the lesser of the balance of the principal outstanding or the fair market value of the property. In non-recourse debt, box 5 is blank, so the sale price is box 2, the balance of principal outstanding. There's some additional questions that we need to ask the taxpayer if he or she receives one of these documents. Was the property for personal use? Was it business? Was it rental property? What was the purchase date? Was the property a principal residence? Was the property a vacation home? What's the cost basis of the property? Was there any depreciation ever taken on the property? Were there any improvements made? And were the property taxes paid, and are they current? Now let's take a look at our first example. Our taxpayer, Stephen Cabela, receives a 1099-A on his principal residence. Now the sale price is $100,000, the fair market value of the property, because this is a recourse debt. He's personally liable for repayment of the debt. So, Mr. Cabela is on the hook for any additional amounts owed after the foreclosure sale. The $120,000 in box 2 minus the $100,000 in box 4 leaves a $20,000 balance. This may generate a 1099-C in the future. So how do we enter this 1099-A into the TaxSlayer Pro Desktop software? Well, from the client's 1040 screen, we're going to select the Income menu, or we can double-click line 13 of the Schedule 1, Capital Gain or Loss, on the 1040 screen. If you choose the Income menu method, we'll select option 7, Capital Gain or Loss, Schedule D. We'll select the New button on the Edit Capital Gain or Loss Transaction box. We'll enter the information in the Schedule D data entry box. For our example, the date the house was originally purchased was 3/1/2015 at a cost of $165,000. We'll also indicate that a Form 1099-B was not received. We'll click OK once all of the information has been entered. Next, we need to select an adjustment code that will appear in column F of the Form 8949. Now recall, the Form 8949 transfers its information to Schedule D. The adjustment code is found in line 7 of the Schedule D Capital Gains and Losses Information menu. And we're going to choose non-deductible loss other than a wash sale for this code. We'll enter an amount in option 8, Adjustment to Gain or Loss, to offset the $65,000 loss from the, quote, sale of the personal residence. Losses are disallowed as tax deductions on personal use property. That's why we have to make this entry on this screen. Now, if I were to print out Form 8949 or view it on the screen, here's what Part 2 of that form would look like after we entered the information from the 1099-A. And if you notice, box F on this form is checked, long-term transactions not reported on a 1099-B, and the $65,000 loss from the personal residence has been disallowed. Now, carrying our example a step further, what if the original cost of the personal residence had been $75,000 instead of $165,000? At first appearance, we have a gain on the, quote, sale of the residence. For the adjustment code, we would now select Exclude some or all of the gain from the sale of your main home. And so in this case, we would adjust the $25,000 gain by entering a negative $25,000 on line 8. And here's what our Form 8949 would look like after we indicate the code and we've entered the adjustment amount. If the taxpayer lived in the house for 2 out of the last 5 years, then he gets to exclude the gain under Section 121. Now, some other issues that might arise. Delinquent property taxes that are paid before foreclosure or with any foreclosure sale funds could possibly be deducted on Schedule A. The $20,000 balance from the recourse loan that's indicated by the Form 1099-A will be reported on a 1099-C in the future. And the taxpayer may have a right of redemption. This varies by state. After foreclosure, the taxpayer could pay $100,000 cash for the house and get his house back. Some other issues: an incorrect Form 1099-A or 1099-C may be issued, and the lending institution should move to correct this. An immediate appraisal can often increase the fair market value, showing a lower, quote, gain. All right, let's look at another example. Example 2. Our taxpayer, Michael Taylor, receives a 1099-A on a piece of rental property, and his condominium unit was purchased March 1st, 2013, and it was used as a rental only. The original cost was $120,000, and depreciation had been taken over the years of $23,271. This is a non-recourse loan. Box 5 is blank, so the sale price is $108,000 from Box 2. So how do we enter this 1099-A into the TaxSlayer Pro Desktop software? Well, first, we'll select the income menu, or you could select line 14, Other Gains or Losses, on Schedule 1 from the 1040 screen. If you choose the income menu, you'll select option 9, Other Gains or Losses, 4797, 8824. And from the Other Gains or Loss menu, select option 1, Form 4797. We're doing this because it's a business property. Then we select option 1, Enter or Edit 4797 Transactions. We'll select the New button, and we'll enter the information for the rental property in the Form 4797 data entry box. And then we'll click OK when we're finished. Now when this screen appears, select type of transaction. We're going to select Part 3, Section 1250 Gain from Disposition of Property. And we're doing this because this property was depreciated. The program will then fill in the Form 4797 menu. And if we were to view or print the 4797, we'll see that the depreciation amount appears, the $23,271, and we have a recognized gain on this line, $11,271. This is line 20, the $108,000, the gross sales price, minus line 23, an adjusted basis. Here's page 1 of the Form 4797 for the rental property. The gain flows to Schedule D on the tax return. Now let's move into cancellation of debt. What is cancellation of debt? It's a release of a debt burden by a creditor. Now this can involve a secured debt, and secured debt uses a house, a car, or other property as collateral. This cancellation is often a two-step process: foreclosure, repossession of property. And any debt not satisfied through repossession of the property may be subject to a deficiency judgment. In the case of recourse debt, the collection will often be pursued, and the debt may eventually be forgiven or canceled. In the case of unsecured debt, an example is a credit card, then no property is used as collateral. As a general rule, cancellation of debt results in taxable income to the taxpayer. It's reported on line 21 of Schedule 1, Form 1040. It may also be reported on Schedule C, E, or F instead. And cancellation is a separate event from foreclosure or repossession. There are exceptions where no Form 982 is involved: a gift, a deductible debt, we'd have to attach a supporting statement, purchase price reduction, and non-recourse debt, and some student loan forgiveness programs. Now there are some exclusions to reporting cancellation of debt income found on Form 982, Title 11 bankruptcy, insolvency, qualified principal residence indebtedness. Now, the exclusion applies only to debt that was discharged after 2006 and in most cases before January 1st, 2018. Reduction of tax attributes. This is Form 982, Part 2. This reduction of tax attributes serves as sort of a balancing act for reporting any exclusion of income. Bankruptcy involves Title 11 of the U.S. Code, Chapter 7, liquidation, Chapter 13, there's a repayment plan, 3 to 5 years. Insolvency can exclude cancellation of debt from income to the extent of insolvency that's reported on the Form 982. And this is a snapshot. It's taken the day before the debt cancellation. Liabilities have to be greater than the fair market value of all assets owned. The extent of insolvency equals the exact amount of the excess liability. We use the Publication 4681 worksheet or a similar worksheet. There is a worksheet found in the TaxSlayer Pro Desktop software. Your client needs to keep detailed records. And again, we refer to Publication 4681, Canceled Debts, Foreclosures, Repossessions, and Abandonments for Individuals. And the insolvency worksheet is found in the publication. Now let's take a quick peek at qualified principal residence indebtedness. This goes for the main home only, and it may exclude acquisition debt only. And that acquisition debt is used to buy, build, or substantially improve the main residence. Non-acquisition debt, home equity debt, is incurred for non-home purposes. Points and other closing costs that are rolled into the principal on refinancing of the acquisition debt are considered non-acquisition debt. And the non-acquisition debt, those bullet points, that's the first debt to be canceled. This produces taxable income. A 1099-C, in this case, would be issued on this non-acquisition debt. Now, if your debt was discharged after 2017, or your client's debt discharged after 2017, the client can't exclude it from income as qualified principal residence indebtedness unless the discharge is subject to an arrangement that was entered into and has to be evidenced in writing before January 1st, 2018. Part or all of the debt may still qualify for one of the other exclusions from 982. Now let's take a look at the components of the Form 1099-C. Box 1 lists the date of the debt cancellation. Box 2 lists the amount of the debt that's been canceled. Box 3 lists any interest, if there was any, included in Box 2. Box 4 gives a description of the debt. Box 5 indicates if the debt was a recourse debt. Now remember, if the box is checked, this means were you personally liable for the debt. Box 6 lists an event code. The event code, why did the creditor file the form? And the codes are defined in the 1099-C instructions. Box 7 lists the fair market value of any property. This is used only in what we call combo 1099-C reporting. So what is combo reporting? Combo reporting or streamlined reporting is available when the foreclosure or repossession takes place in the same calendar year as the cancellation or the forgiveness of debt. Some indicators are real estate description in Box 4 or fair market value listed in Box 7. Now, as far as the 1099-C correlation to the Form 1099-A that we talked about at the very beginning, the 1099-C Box 2 listing the amount of the debt discharged plus Box 7, the fair market value of the property, equals the balance of the principal outstanding. And this amount correlates to Box 2 of the 1099-A. Now let's go through an example of entering a Form 1099-C in the TaxSlayer Pro Desktop software. Our client, Howard Buckner, received a 1099-C from First National Bank, and we see in Box 2 of the 1099-C that the amount of debt discharged is $20,000. We see in Box 5 that Mr. Buckner, personally liable for repayment of the debt, it's a recourse debt. We have an identifiable code in Box 6, Code G, and this is used to identify any cancellation of debt as a result of a decision or defined policy of the creditor, First National Bank, to discontinue collection activity and cancel the debt. Box 7 lists the fair market value of the property at $100,000. The debt description is a residence, 600 Elm Street, Augusta, Georgia 30904. So that we can relate this example to the tax program, we're going to assume that the discharge of Mr. Buckner's debt is subject to an arrangement that was entered into and evidenced in writing before January the 1st, 2018. And remember, qualified principal residence indebtedness is any mortgage that you took out to buy, build, or substantially improve your main home. Also must be secured by your main home. So how do we enter this 1099-C into the tax program, into the TaxSlayer Pro Desktop software? We'll select the Income menu. We'll select the Other Income menu. We'll select Option 4, Cancellation of Debt 1099-C. We'll select Option 1, Form 1099-C, Cancellation of Debt. We'll select the New button from the Form 1099-C entry box. And we'll enter the information from the Form 1099-C and click the OK button. The creditor's ID number, the creditor's name, First National Bank, and the amount of debt canceled, $20,000. We can review the information from the Form 1099-C and then exit this menu if the information is correct. Now, if there's only one 1099-C on the return, we'll exit the Form 1099-C input box. Now, because the 1099-C was generated from the quote sale of a personal residence, we're going to access Form 982, the reduction of tax attributes. we're going to indicate that the amount to be excluded from income is due to the discharge of qualified principal residence indebtedness, and we'll click the OK button. Next, we're going to enter the amount to be excluded from gross income, the $20,000, and it'll show up on the Form 982 menu the total amount of indebtedness excluded from gross income as a negative amount. So now what did we just do? Well, we've reported the 1099-C to the IRS, and we've subtracted the discharge from indebtedness from the taxpayer's income. And below is a copy of the client's Form 982, and again, in this example, all of the mortgage debt was qualified principal residence indebtedness. Now for our final example, we'll look at an insolvency 1099-C issued by the Visa Credit Card Company to Clark Howard. It's credit card debt. The amount of debt discharged, $53,500, and a bankruptcy event code is not listed or present. So we go to insolvency. Now to enter this 1099-C into the tax program, again, we start off at the income menu. We'll select the other income menu. We select the Cancellation of Debt 1099-C menu. We select 1099-C. Click the New button. And we enter the information from the 1099-C. When everything is correct, we'll click the OK button. We'll review and then exit the 1099-C information menu, and we'll exit the Form 1099-C menu. We only have one 1099-C to enter. Now comes the fun part. To enter the insolvency worksheet information for the client, we'll select Form 982 from the Cancellation of Debt menu. We'll check the appropriate box, Discharge of Indebtedness due to the extent insolvent, and we'll click OK. We'll select option 2 to calculate the amount of indebtedness to be excluded from gross income. You'll now be at the insolvency worksheet menu. We'll enter the client's liabilities and assets to determine the amount of insolvency. First, we're going to enter the client's liabilities. He's got credit card debt of $53,500. He's got a mortgage on a house of $175,000, and he's got other liabilities or debts that aren't included above of $32,000, making a total of $260,500. Now we'll enter the assets. Has cash and bank account balances of $4,500. His home, including the value of the land, valued at $190,000. Cars and other vehicles, $15,000. Household goods and furnishings, $10,000. Making the fair market value of his total assets $219,500. So now the total liabilities exceed the total assets, and the client will be able to exclude some of the debt. The amount of insolvency, $41,000. The amount to carry to Form 982, the same, $41,000. The calculated amount from the insolvency worksheet will pull to the TaxSlayer Pro Desktop Form 982 menu. Total amount of indebtedness to be excluded from gross income, $41,000. Now, according to the insolvency worksheet, the taxpayer, Clark Howard's not able to exclude all of the credit card debt, but he will be able to exclude $41,000. And here's what the client's copy of the insolvency worksheet looks like. And so in this case, the taxpayer will have $12,500 of income to report on Schedule 1, Line 21, Form 1040 in the Other Income menu. And this will carry to the Income menu of the program, the Other Income line. Flows to Schedule 1 of the Form 1040, and eventually will show up on line 6 of the Form 1040 itself. So in summary, foreclosure and cancellation of debt are two separate reportable events for a taxpayer. They're reported on a 1099-A and a 1099-C. In some cases, streamlined reporting, the taxpayer will receive a 1099-C only. In some cases, the 1099-A will precede the 1099-C. Information gathering is essential for correct reporting and minimizing the tax liability for our clients. And remember, foreclosure is reported as a, quote, sale. Canceled debt is ordinary income unless an exception or exclusion applies, and we report these on Form 982. And thank you for watching this TaxSlayer Pro training video on 1099-A and 1099-C reporting.